Remember those stock market gains rung up in May and until yesterday and today in June? Well, they are all gone now. Victims of a two-day slide that began yesterday and only got worse today. In fact, today was the worst day of the year for the Dow and the S&P 500, and save for a rally in the dollar, there was basically nowhere for investors to hide. Not equities, not bonds, not commodities. Now, the main trigger, of course, was yesterday's declaration from the Fed that it's ready to begin winding down its stimulus program. The losses were compounded, especially in commodities, by weak data on Chinese manufacturing. On Wall Street, roughly 20 stocks declined for every one that advanced on the New York Stock Exchange. All 10 S&P sectors were down, declining more than 2% each. The two-day drop was the biggest in percentage terms for the Dow and S&P since 2011, and the Dow is now off 5% from its all-time high set just a month ago. At the close, the Dow tumbled 353 points, ending well below 15,000. The Nasdaq lower by 78, the S&P 500 down 40. No matter where your money is, there's almost surely less of it today than there was yesterday. Virtually no asset, not stocks, not bonds, not commodities, was untouched by today's massive second-day reaction to yesterday's Fed speak. Words that arguably signal good news in the long run.
The committee believes the downside risks to the outlook for the economy and the labor market have diminished since the fall.
Instead, investors pulled the ripcord as Chairman Bernanke put firm dates on the long-feared tapering of market-boosting bond purchases.
The committee currently anticipates that it would be appropriate to moderate the monthly pace of purchases later this year.
And like Joe Frazier way back in '73, down went stocks, down went bonds, down went oil and gold and silver. All 30 Dow stocks lost value today, so did 96% of the S&P 500. Treasuries tanking, yields on the 10-year note topping 2.4% for the first time since August 2011. Oil down to $95.40 a barrel, lowest in months. Gold off more than 6% to its lowest level in almost 3 years. The drop in silver was the steepest among the precious metals, down more than 8%, also cheaper than it's been in almost 3 years. And now what? If nothing else, higher interest rates might be a good sign for savers. But are your investments at a crossroads? Are the good times of 2013 over? Or is this a chance to take advantage of lower asset prices just as the economy shifts into a higher gear?
One point that we think a lot of investors are missing, though, is that the fiscal drag to the economic growth scenario for the U.S. next year becomes far more favorable.